With the amount of current shares outstanding, they pay out in dividends every single year, roughly $1.7 billion. And then after we subtract this from the 5-year average free cash flow, they're left with $1.24 billion. As of the last year's free cash flow, though, it is negative $1.52 billion. This is exactly what I'm talking about. Their last year's free cash flow is extremely low. So they cannot afford this in the slightest. In fact, their last year's free cash flow's payout ratio, it is 1,176%, guys. I like under 60. This thing is way beyond that. For the 5-year average, it's 57.25. It's nearing that 60%, as well as the fact that if you take a look at those cash flows, they do not look good in the slightest. So this is why I'm saying that even though they have 47 consecutive years of dividend payment, I think that this is going to get cut real soon.
2 days later.
So today, guys, was quite an interesting day. We had Walgreens release their earnings, and oh dear Lord, that was a bloodbath because, well, yeah, they cut their dividends. Obviously, you guys know by that intro, but they cut their dividends by nearly half. And again, this is what I was talking about in that video where I literally said, it's the title of the video, Walgreens dividend is not due for this world, and that they will most likely cut it or even suspend it. And they actually ended up doing that. In fact, here you have it. Walgreens Boost Alliance almost halves dividend to 25 cents. Yikes. Again, this did have a yield of like, what, 7%, which is crazy. Walgreens Boost Alliance declares 25 cents share quarterly dividend, 47.9 decrease from the prior 48 cents for a yield of 3.91 now. Again, before it was like 7. Payable for March 12th for shareholders on record February 20th. Ex-dividend date will be February 16th. Now, here's the fun part right here. We have made the difficult decision to reduce our quarterly dividends payment to 25 cents per share to strengthen our long-term balance sheet and cash position, said Executive Officer Tim Wentworth. And again, if y'all remember, I was talking about this, guys. I kept it what it was prior, but here it is. I was saying that, this amount of dividends paid with this amount of free cash flow left on the last year's, there's no way they can sustain this. They need that cash. And the CEO literally just said that right here to strengthen our cash position. So I'm going to pat myself in the back here because I called it. To be fair, it's not like I'm psychic or anything. The fact of the matter is that, guys, numbers don't lie, right? I mean, you look at this and it's very simple to see, oh, they can't afford the dividend in the slightest. This will most likely get cut. So it is what it is, but they did have earnings, and their earnings was actually fairly decent. In fact, here we have the earnings summary. Walgreens Boost Alliance non-GAAP EPS of 66 cents beats by 2 cents. Revenue of $36.71 billion beats by $1.6 billion. So everything is going, I guess, great when it comes to the bottom lines, I guess you could say, and even the top lines. So we got over here, Walgreens Boost Alliance press release Q1 non-GAAP EPS of 66 cents beats by 2 cents. Revenue, wow, look at that. Revenue's up 10% year over year as it beat by $1.6 billion. Announcing a 48%, we already saw that one. Maintaining fiscal 2024 adjusted EPS guidance of $3.20 to $3.50, with underlying earnings growth more than offset by lower sale and leaseback contributions, a higher tax rate, and lower COVID-19 contributions. Obviously, COVID is just not in the radar anymore, guys. I mean, it's been almost 4 years now. Yeah, people are over it. Maintaining U.S. healthcare and adjusted EBITDA to be break even at the midpoint of guidance range of negative 50 million to a positive 50 million. So basically, that's a big range right there. Now let us take a look at their actual earnings report. And of course, this will be linked in the description below, guys. I'm actually going to link this page over here just so that way you guys get the whole entire thing. But we're going to take a look at this PDF. Now, I'm only going to take a look at what the CEO actually had to say and the CFO as well. So let's see over here. Quote, since the start of the tenure with WBA, we have been evaluating our options across our strategies and operations, including those relative to our capital allocation. Wow. He's coming out straight off the bat with just like, we're cutting the dividend. That's the first 2-3 sentences, technically. We have made the difficult decision to reduce our quarterly dividend payments to 25 cents per share to strengthen our long-term balance sheet and cash positions. The actions that reinforce our goal of increasing cash flow. Called it. Wow. What a call. It's almost like fundamentals drive companies. It's almost like that's the thing. It's almost like these things aren't just ticker symbols. It's like they're actual companies with balance sheets and income statements and cash flow statements. No offense, Mike, but you really can't see these things from a chart. No offense. Still love you though. Anyways, while freeing up capital to invest in sustainable growth initiatives in our pharmacy and healthcare businesses, which we believe will ultimately improve shareholder value. That's fine. That's fine. I'm actually fairly happy that they did cut their dividend. In fact, I would actually go a step further, get rid of it completely, right? Please get rid of it completely, because you need to focus on, you need to clean up the mess, right? Before you can give to other people. So I suggest clean up your balance sheet, right? Don't pay out the dividend. In fact, if they start, well, I wouldn't say issue shares, but if they just don't issue any shares or even buy back any shares, that's great too. Now we got over here, actually the CEO continued. We got the WBA board is committed to ensuring the capital allocation priorities are balanced and between investment opportunities for growth, debt pay down, and returning cash to investors. Importantly, we are maintaining a competitive yield as our board continues to view the dividend as a key component to overall attractiveness of WBA to many shareholders. That's actually true, because currently the yield is still above normal levels. In fact, guys, Seeking Alpha actually hasn't updated this yet, but if we just do basic math, and the way we do this is, well, we just take the annual payout, which being 25 cents per share quarter, multiply that by 4, that ends up being $1, right? $1 per year, and then we divide that by this current share price of $22.26, and we get 4.12. So that's still well above average. Like, it's still well above average. So I look at this and I'm just like, yeah, they need to go a lot further. Honestly, they should just suspend it entirely, but that's just me. All right. With that said, though, I am very, very curious to see if maybe we want to change anything regarding the calculator. Mainly the discounted free cash flow, because at this point, I'm like, okay, last time we talked about this, I put this thing between $21.40 to $23. Right now, this would be a really good price, but seeing the current situation, I don't necessarily know. So I look at this and I'm just like, this is interesting. If we take a look back over here, this is a 10% increase year over year. Oh man, I do not necessarily know what to put for this. I think I'm going to stay the same when it comes to the revenue growth. Here's the thing though, for the predicted share buyback, I think, guys, at best case scenario, a medium assumption, they're going to do 0. Lowest, I think they might actually issue a few shares here and there. And then for the highest, honestly, I don't even know. They might buy back like 1%. That's really it. So now the numbers change from $20.98 to now $22.95. It's still looking like a great buy, but honestly, I look at these fundamentals, especially that free cash flow, guys. No way. Granted, with this amount of dividends that are now being paid, if we change this annual dividends per share to now $1, right, this actually comes down to, wow, look at this, guys. Look at this. Now the amount of dividend paid every year ends up being $863.7 million, whereas before it was $1.6 billion. That's a massive, massive difference. And then when it comes to the 5-year average free cash flow after the dividends paid out, it's still $2 billion. As of the last year's free cash flow, it's still negative 722. These payout ratios are still not looking good. At least for the last year's free cash flow, 612.55. It's still really high. 5-year average, sure, it's lower in comparison to what it was, right? Because, I mean, let's see, what it was 57, so it actually isn't that much lower. But the last year one, it's significantly lower. It's still too much. This is why I suggest me, right? If I was the CEO of Walgreens, I would just be like, we're suspending it. Guys, I'm sorry. We just can't do it. Put it at 0, right? Keep this free cash flow. The last year's free cash flow is only $141 million. They need to fix this. They really do. So that's just my 2 cents on this. And this is personally why I didn't think that Walgreens was going to keep the dividend. So there it is. So when it comes to a company perspective, they need to fix their fundamentals. Even though the calculator is actually showing that this is a decent buy, even still, guys, look at this amount of debt. This is in the negatives. They still have a ton of debt that they need to fix. So all in all, I personally think that, yeah, I think Walgreens should go a step further. I really do. But anyways, that pretty much does it for this video, everybody. I'm actually going to put out a short as well. You will see the short before you see this one. It's basically saying what I just said in about 60 seconds. So yeah, all in all, yeah, interesting. Very, very interesting now, isn't it? It's funny because I actually told Mike about it, and then he said, next time you find another one like this, tell me, because I want to short it. And I'm just like, okay. So, yeah. All right, guys. Thank you so much for watching. Make sure to like, subscribe, comment. It really does help with the algorithm on YouTube as well as Rumble. Of course, make sure to follow us on X. And with that said, peace out, and we'll see you all next time.